Richard Powers. I'm an associate professor at the Rotman School of Management, and today I'm with David Beatty, Director of the Clarkson Center for Business Ethics and Board Effectiveness. David, we're here today to talk about dual-class shares. I think it's fair to say your views have changed on that a bit.
Yes, you're right, Rick. I used to believe there was only one way to do things, and that was one person, one share, one vote. And today I've come to a different point of view.
We had the debacle with Magna a few years ago.
We did. And as I recall, he owned 1% of the company, but he had 99% of the votes. So he was able to restrict himself to only $75 million a year in basic compensation.
Not a bad deal if you can get it.
It's a great deal if you can get it.
So that's the argument against dual-class shares. What's the argument for dual-class shares? Tell me about the Clarkson study.
We looked at the Clarkson Center at the performance of dual-class shares over the last 20 years in the Canadian stock market and compared controlled companies that had dual-class shares with uncontrolled, and they outperformed. Now, why did that happen?
These are primarily family-controlled companies, aren't they?
Not necessarily. They could be individuals who might subsequently give the rest of the family some of their shares or not. But one way or the other, the firm was controlled by the individual who owned and controlled the votes of those shares.
Was the return significantly different?
40%.
Is that right?
Over
40%.
15 years. Huge.
David, is this a Canadian trend, or are we seeing this elsewhere?
Well, we did the work here in Canada. I don't think it's been replicated in other jurisdictions. But then you think about why would that be the case? And my view is that it's a longer-term orientation. I mean, you don't educate your kids for the next quarter, for example. You educate them for a lifetime. And similarly, if you have a controlled corporation, especially if it's family-controlled, you're looking generationally. You're not looking at the next quarter's earnings. You're looking at the next 3, 5, 7, 9, 10 years. So there's I think there's a very strong likelihood that you're going to get a better, longer-term performance from a controlled corporation than from a widely held company.
New companies listing, particularly in the tech industry, this is the norm, isn't it?
It really is, yes. The largest public offering in history was Alibaba, which came to the New York Stock Exchange, $25 billion IPO, multiple voting shares. Two guys control the company. Out west in the Silicon Valley, anybody going public is going to go with two-class shares. Mark Andreessen runs a big fund for high-tech ventures in Silicon Valley. He said at a public conference, if I ever take a company public again, of course it'll be dual-class shares. I don't want some 26-year-old analyst from New York phoning me up telling me what I ought to be doing. I'm trying to work with the management to create the future. I want to spend 125% of my time on it. So of course I'll have dual-class shares.
And if ISS or Glass Lewis give these companies a poor governance score, they're happy.
Yes, that's right. He did say, if I get the worst governance score in history from ISS, it would make my day. And the audience went bananas.
Dual-class shares, they're here to stay.
They are the dominant form of shareholding around the world, so they're not going away. And unless we think about what best practices are in this arena and how to get the hard edges sawed down a little bit, we're denying ourselves access to a huge percentage of the capital markets.
Thanks very much, David.